Good evening, ladies and gentlemen, and welcome to our class, Understanding CFDs and Forex. Tonight's class is sponsored by CMS Trader. That's at www.cmstrader.com. They are one of the world's leading experts and providers of Forex and CFD trading. Now, tonight's class is going to be a general introduction, and tonight's class is also recorded. If you want to access the recording, please use the same link you used to come to tonight's class, but you'll have to give us about 24 hours to get it uploaded and in place. Now, Warren Buffett, as you all know, is one of the world's most successful traders, and he warns everyone, successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. Well, what he's trying to say is you're not going to get rich overnight, and you're not going to conquer the markets in a matter of a day. It takes time and effort, not making lots and lots and lots of useless trades to be pushed out of the marketplace. It will take you time to master trading. It will take you patience, and the most important factor when trading is understanding risk. And CMS Trader, our sponsor for tonight, is a regulated provider, so I'm therefore required to give you a risk warning. Trading Forex, CFDs, and spread betting on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, as I said, tonight's class is sponsored by www.cmstrader.com. And if you go to their website while we're having class, you can very quickly set up a demo account in no time flat by simply clicking the buy or the sell button. It'll ask you to put in an email address and select the password, and you'll be able to actually do some demo trades as we go along in class and understand what and use that to understand what we're talking about in class tonight. And CMS is one of the world's leading providers. They are regulated, so you know all of your trades are safe and above board and transparent. They have no dealer intervention, no conflict of interest, and they offer an extremely broad educational package to all of their traders. You can have multiple kinds of trading accounts with them. You get free daily signals. You have free daily market updates and technical analysis, and order execution that's as fast as light. They offer a wide range of trading assets. You can trade Forex and CFDs for stocks, commodities, and indices. Now, you can also use their watch, copy, and profit, where you can use their social trading and watch their most successful online traders and copy their exact trades. You can also learn how to become an independent trader with CMS Trader. They offer a full range of video tutorials for beginners and professionals, as well as one-on-one sessions with financial experts. So let's get started with tonight's class. And let's start at the very beginning. Now, a lot of people mix up Forex with CFD, or they want to know how they can trade currency with a CFD trade. Well, basically, Forex, you can't trade Forex with a CFD because Forex is almost like a CFD. You have a sell price and a buy price. When you're trading CFDs, which stands for contract for difference, you never actually own anything. All you're doing is making a contract for the difference in the price in which you open a trade and for which you close a trade. And then you select how many units you wish to buy. So in other words, if, say, hypothetically, if Bitcoin is trading at 44.50 today, and you want to buy 10 Bitcoins, okay, well, that would technically be $44,500. but you're not ever buying the Bitcoin. You're not taking possession or ownership of the Bitcoin. But if you were to buy it now and sell it at the end of the day for $44.51, you would get the difference, which would be your profit, or the 10 Bitcoins times $1 or $10. Now, that's not complicated, but the thing that is confusing is you wanted to buy those 10 Bitcoins, but you don't have $44,500. So you use what's called leverage or margin, which is what all that's required when you're trading a CFD is a small deposit. And when you make that small deposit, it's usually a very small percentage, but you have to calculate, and we'll talk about what leverage or margin is. So if you wanted to buy those 10 Bitcoins that were worth $44,000, most likely your deposit or your margin would be a couple $100. So that allows you to ramp up your trading because you didn't have $44,000 in your account. So CFD stands for contract for difference. This type of financial instrument allows you to benefit from the fluctuation in price of stocks, commodities, indices, and more without really purchasing them. You can profit from the difference between the opening price and the closing price. It's important to us to emphasize you don't own the asset you trade. CMS Trader is one of the first online brokers to offer CFD trading. Now, a CFD is a leverage derivative. Because you don't own anything, the value of that contract is derived from the actual spot value of what the asset would be selling for. So in other words, if Bitcoin was selling at $44.50, since you're not buying Bitcoins, the product or the value of your contract would be derived from the value of the Bitcoin. Okay, because it's not a spot Bitcoin, you're not buying, because you're not actually buying something. So it's a derived product, so it's called a derivative. CFDs are derivatives because their value is derived from the value of another asset. When you trade CFDs, you take a position on the change in the value of that underlying asset. Now, it's very easy to understand buy low, sell high. You can also sell high and buy later lower. Okay, so in other words, if you thought Bitcoin was trading at $44.50 and it was going to go up $10 today, you would buy it at $44.50 and sell it at $44.60. Now, to execute a CFD, you have to actually execute two trades. One is when you open your position, and one is to close your position, and they're the opposite of each other. So if Bitcoin, you were buying Bitcoin to start out with at $44.50, you'd have to sell that Bitcoin to take the profit. And if it went to $44.60, you would get the $10 per Bitcoin you bought as a profit. Well, because you have to do two contracts, one to buy and one to sell, one to open and one to close, you could open a position first to sell Bitcoin at $44.50, and then when Bitcoin fell to $44.30, you could buy it to close that position, and therefore you sold it earlier in the day at $44.50, but you didn't have them, so you closed your contract by buying them, and you bought them at $44.30. So you sold something at $44.50, you bought it at $44.30, you make the difference. So you can both buy and sell, or go long and go short when trading a CFD. Now, you can trade shares in a CFD format. You can trade indices, commodities, and treasuries. The only thing that doesn't come in a CFD format is the foreign exchange, which is Forex or the foreign exchange. Okay. But you get into a foreign exchange market basically the same. It's leveraged. you have margin, and you're buying and selling. But in the foreign exchange market, you're buying one currency while selling another currency simultaneously. Okay. Forget about what you have on deposit in your account. Because if you live in London, you might have your account in pounds. If you lived in Japan, you might be holding your account in yen. That's just the money you have on deposit. If you wanted to trade the euro US dollar, because currencies in the Forex market are always traded in pairs, one against the other. So if you wanted to trade the euro dollar because you thought the euro was going to go up in value today, you would buy euros and sell dollars. To get out of that position, you would do the actual opposite. You would buy euros and sell dollars. So if the euro went up today against the dollar, you would make profit. Now, if it went up because Mario Draghi came out and said something positive about the Eurozone, so it went up in value, you'd make profit. But on the other hand, it could go up in value simply because something very bad happened in the U.S., or Donald Trump did something crazy, and the value of the dollar went down, which would enhance the value of the euro. So you can benefit in two ways. But they are always trading pairs. Okay. Now, in a CFD trade, okay, you can buy gold, you can buy oil, you can sell Bitcoin, you can buy Apple. I mean, shares are about the easiest to understand. Okay. Let's give you an example. I don't know what Apple's trading for today, so let's say hypothetically Apple's trading at 150 today. Now you think that something positive is going to happen with Apple. They're going to announce the release of their new phone, or Tim Cook's going to get out and tell you that Apple's phone sales are skyrocketing higher than expected. But you think something is going to send Apple climbing today. Well, if you had $1,500 in your account and you wanted to buy some shares of Apple, $1,500 at 150 shares would only buy you 10 shares of Apple. Correct? Basic standard mathematics. So if you called your stockbroker and said, I want to buy Apple, he said, fine, give us $1,500, we'll get you 10 shares of Apple at $150. Well, if Apple did very well today and went up $4 on your 100 shares of Apple, or your 150, your 10, 10 shares of Apple, your 10 shares of Apple, and Apple went up $4, you made $40. You didn't even cover the commission. Now, there you would actually own the Apple shares. You took technically possession. Your broker bought them and he had the stock certificates, and you could have them sent to you if you want, but you actually own those Apple shares. You could go to the bank and take a loan against them. $1,500 is not much you could do, but okay. If you took Apple in a CFD, a contract for difference, you would still get those 10 Apple shares. You had $1,500 in the account. Apple was trading at $150, so you would get a contract for those 10 shares of Apple. But because Apple was on, say hypothetically off the top of my head, I'm not doing mathematical calc, on 100 to 1 leverage, okay, you only needed to come up with $15 as a deposit. Okay, that's it. So to get your contract for difference, you bought Apple at 150, but you only need to come up with $15. So you said, instead of 10 shares, give me 100 shares. Give me 1,000 shares. Okay. So for 1,000 shares, you'd have to come up with $1,500. Your broker, and now margin isn't a check you have to write. It's a deposit, but it doesn't technically come out of your account. It's got to be in your account and can't be used for anything else at the moment. That's all it is. When you close your position, it all stays there and it's over and done with. But you now tied up 1,000 shares of Apple trading at $150. And when Apple went up to $4 and closed at $154, you made $4,000 on your $1,500 account. That's huge profit. Now, the fact is, you have to remember, at all times, Your exposure or your risk is the exact reverse. Apple could have gone down those $4 and you would have been out of your pocket, not $1,500 because that was just your deposit. You would have been out of your pocket $4,000. Okay. So you have to understand, leverage ramps up your potential profits, but the same ramps up your potential exposure. But it allows you to trade a smaller account with a smaller amount of capital to make a significantly larger amount of money. It does increase your risk and your exposure, but if you only had $1,500 and everything you had to do, you had to buy the $15, and every time you traded Apple, you only made $40 and your commission was $30, it's not worth the risk or the effort. And most of us don't have $100,000 to throw into an investment account to take it out. But your risk remains the same at all times. So always be aware of the risks. Finally, it cannot be stressed enough that trading the financial markets carries a high level of risk and may not be suitable for everyone. Before deciding to trade, whether it's foreign exchange or CFDs, you should consider your investment objectives, your level of experience, and your risk appetite. Remember, you could sustain a loss of some or all of your initial investment, which means you should not invest with money that you cannot afford to lose. If you have any doubts, we recommend that you seek advice from an independent financial advisor. Now, let's look at the differences that you can trade, or the different types of trading that can happen. But don't be intimidated or confused by all the terminology, because most of us don't have enough money, don't have large enough accounts to really get involved in all the little insignificant differences. Because there are benefits to each type of account or each type of trade, but most of them don't really apply to the standard retail trader. They apply, but our accounts aren't large enough. We're not trading with big enough money, and it becomes such a small percentage. It's not important. But let's start off at the very beginning. There are three types of trades. We call these spot, we call CFDs, and we call futures. Now, spot sounds just like it is. It's on the spot. So if you wanted to buy gold and take physical delivery, or actually own it at the moment, you don't have to go pick it up and have the gold bars in your hand. But if you went to a coin dealer and bought gold, gold coins or gold ingots from him at the spot price, that's the price you're actually taking it, ownership, and putting it in your pocket, putting it in your safe deposit box. Or, your broker can be holding it on for you. But it's spot. You physically own it. It is yours. In the stock market, if you're buying stocks, it's basically spot, because you're taking possession. When your broker initiates that trade or executes that trade, those stock certificates are being issued in your name, and you own those certificates. So if you actually wanted, like I said, wanted to go to the bank and take a loan against them, put them up as security, you could. Just like when you bought the gold. Now, if you bought 20 ounces of gold or 50 ounces of gold, or you had a couple pounds of gold, you're not going to walk them around, but they will be stored somewhere. Somebody will have them in your name that you own them. That's the spot market. Now we're going to jump past CFDs and go over to the futures market. The futures market, you actually own certain rights, and you own the rights to buy or sell a particular asset in a particular time period at a very specific price. So you own those rights. So those rights have value also. So to uncomplicate it a little bit, say there's a new apartment house going up down your street, and real estate in your town is booming. Now, technically, you can't buy that apartment house because it doesn't actually exist. They're just digging a hole in the ground. So that condominium or that apartment you want to buy, you're signing a contract which gives you the right to that apartment for when it's finished to take delivery at a specific price. That's futures. Now, there's some things about futures. They have an expiry date. They run out of time. Just like that condominium. Okay, if you bought it for $1 million or €1,000,000 and you put down €1,000 or 10,000 or 100,000 euros to tie it up, when it became finished and there was a certificate of occupancy and the builder said, okay, it's time to pay me and swap the papers, you didn't have the money. In his contract, it probably says 30 days after the date of notification that it's ready, if you haven't closed escrow and taken delivery, he can put it back on the market. Well, this is kind of what happens in the futures market. But we have futures for just about every month. And futures, you're usually, and because you were buying that condo as an investment condo, because you thought it would go up in value, so what you were hoping is never actually to take delivery is when he told you it was ready, you could put it on the market and sell it at a higher price. And all you would do is take the profit from in between. Well, that's what happens really in the futures market. You would buy oil for delivery in the month of, say, hypothetically August, and you buy August, UK oil hypothetically, and because you thought oil would be up in value in August. So to secure those rights today to buy that option, that future, you would put down a small amount of money. Now, will come in August when the price is higher, you could then sell it and you would make the difference between where it was when you opened a trade, or not opened a trade because you didn't actually open, where it was when you bought the rights to that oil, okay, and where it is now. And you just take your little profit from the center. It's called speculating. But you need to know first is that what asset is underneath of it. That is the most important. What is the underlying asset? For example, you may want to buy gold. You could buy spot gold. That's the price which it will be the same as the physical gold. You can buy gold CFD and a gold future. But the price fluctuations are likely to be extremely similar. Now, a CFD, the value of the CFD is derived from the spot price of that asset. It's not going to be exactly the price of spot gold. There'll be a slight differential, but not significant enough for us traders to number one, understand, and number two, to make a difference in our trade. Now, if you were a guy who was trading a couple $1 million and you had a choice of buying that gold or buying a CFD, and you said, well, the difference is small, but I'm buying, I got $1 million with leverage. I can leverage up to $100 million worth of gold. Well, that's significant enough. And maybe the difference will make a couple $1,000 or $10,000 or $20,000. Okay. But a CFD is a contract which uses the value of the underlying asset. Now, it's not a scam. It will move. If you see that gold goes up a point, so will the CFD contract. But the CFD contract may have started at $12.50 and gold could be at, spot gold could be at $12.49.92. But later in the day, it's still going to be those few pips difference. It's going to move in a standard basis. It's a standard predetermined, and you have no say in it. It's what the contract is devised as, and it's spelled out in the whole contract if you want to read the whole 9,000 pages, that, when, it's using, it tells you exactly what the underlying asset is and what the differential will be in the moves. It's not like it spreads apart or anything else. It just flows along. Now, again, because we are retail traders, it doesn't have a big enough significance to either one of us. So the debate about CFDs versus Forex versus futures is really a waste of time and not worth worrying about. Spot and CFD are essentially the same thing at this level. Differences in the price movements should only occur when a CFD has leveraged itself, which is not very common. Futures are a little bit different as they are less liquid and their price is influenced more by market forecasts. The important thing is that you check out each instrument and know the difference, because some of the biggest differences are the tax scenario. Depending on what country you live in, could be different taxes. So like in the UK, CFDs are not taxed, whereas spot or futures are taxed at different levels. So you're better off trading CFDs. Okay. But in most of our cases, our broker's only offering us one thing, which is CFDs. Because if you want to go to futures, you have to go to a futures broker. If you want to buy spot, you have to be trading with a spot, a metals dealer or an oil dealer. So it does make a difference where you are trading. But when it comes to Forex versus CFDs versus futures, you will almost find that the major spot Forex pairs are also the cheapest. Okay. Now, when you're trading, the more popular the asset is, the less it's going to cost you, and the more liquid it is. What do we talk about this? And when you're trading CFDs and Forex, there is no technical cost of trading. There's not a commission. It's done through what's called a spread. The spread, like I told you, you had to execute two trades, a buy and a sell trade. One when you open your position, one when you close a position. Okay, if you're trading the currency, you're opening and closing two positions. The spread is the difference from which the broker will either sell you a contract or the price he'll buy you a contract. Okay. Now, to explain that a little bit easier is all of us have gone on vacation somewhere, so we've gone to a currency exchange place. And when we go to currency exchange place, we see on the wall no commission, but they have a price they'll buy you the currency from you for and a price they'll sell you the currency for. So in other words, if you're going on vacation or you have, say, euros and you want to buy dollars and the euro US dollar is trading at 122 today, you're not going to get the 122. If you're selling euros, it may charge you 123, and if you're buying dollars, they may charge you 121. So it's really how the broker's commission is structured, and it's simply in what's called the spread. But again, in most of our cases, it's only a very few points. It's very, very small. So in most of our cases, it's, again, and all the brokers are basically competitive. If you're using any of the big brokers or regulated brokers, okay, if you're trading the majors, you're trading big stocks, you're trading the primary commodities, you're trading the big indices, you're trading the primary currency pairs, they're all competitive. It's when you go off to the exotics. You know, if you're trading with a broker and you want to trade the Russian ruble against the real, or you want to trade the Mexican peso against, you could have it. But because they have to sell this trade into the marketplace to the liquidity providers, there's less and less liquidity providers that deal with that currency pair or that unique asset. Okay, that unique, there's commodities for salmon exchange. There's commodities for electricity. Well, but those go through very small independent asset providers who charge much higher fees, so that therefore what happens is those fees get pushed off to you. So the spreads are higher. So if you're going to trade, be aware of this. You're trading outside the majors, it's going to have a higher cost of doing business to you. But unfortunately, the cost doesn't end there. Forex brokers also charge to hold most of their trades overnight. But very often they do not advertise these charges explicitly on their website. But they are very minute and they are very competitive. If so, contact them and they will be more than happy to tell you exactly what their rates are. And then make your cost calculations again, but they're minute. But if you remember, in the Forex market, because he's got to execute two trades. If you're trading the euro US dollar, your broker has to go into the open marketplace, and even though you're buying 100,000 euros and you're only putting up $1,000, he has to go into that marketplace and physically buy euros and sell dollars. And so therefore he has got to go in there and finance, because he has to buy whatever he's offering you the leverage for. So he's got those overnight interest rate charges because he needs to have the interest because he's putting out the money. And so that's factored in there. But again, it's so small per trade that you should be aware of them, but not involved. What you should be most aware about at all times is risk, risk, and more risk. It is important that each trader evaluate their risk involved in each style of trading and understand the differences and the potential traps and errors. Do not trade what you do not understand. So once again, a CFD is the difference between where a trade is entered and exited. And if you can get this in your head and go away with buying and selling and highs and say, it's the difference between where you entered a position and exited a position. So if you entered as a buy and you exited as a sell, or you could enter as a sell and exit as a buy. Now, a CFD is a tradable instrument that mirrors the movement of the asset underlying it. It allows for profits and losses to be realized when the underlying asset moves in relationship to that position taken. But the actual underlying asset is never owned. Essentially, it's a contract. Now, this is important. Not only is it a derivative, it's also a contract between you and your broker. CFDs are not exchange-traded items, although they are regulated. So they are regulated by a regulator. They are monitored very closely, but they are contracts between you and your broker. So that has advantages to you. Trading CFDs has major advantages, and these have increased the popularity of the instruments. One of the biggest advantages of CFD is how fast it's executed and what happens when markets get highly volatile and the liquidity dries up. Since a CFD is between you and your broker, it is executed almost instantaneously. There's no quotes and requotes, and it's at the price you see on the platform when you're trading. But it also means that when you close your position, it is executed as fast. Because when you're trading in exchange traded items, you get a price, but that trade has to be put through the exchange before it's closed, and that final price isn't final until it is executed entirely. Which means, like, all of us remember, it was almost 2 years ago, when everything went crazy with the Swiss franc, where you saw big brokers going broke overnight because they had offered so much leverage and they were in the markets on your behalf. But then what happened was the markets had gone crazy, and you were saying, sell my position, close my position, open my position, do something. Not in CFDs and Forex. And because it had to go through an exchange, a lot of those trades couldn't be executed. Or because you had a stop loss, which prevents your loss at a certain price, that stop loss is only guaranteed if the broker, at that whatever price you've entered that stop loss to protect your risk. If the broker's computers can't finalize that or execute that trade because there's no liquidity in the market, it's not the broker's fault at all. It's in their paperwork. And what happened was so many people got stopped out because the markets got so volatile and so bad that they couldn't even get out of their trade until it was way beyond what they expected. And they ended up with negative accounts because the brokers finance your trade. They become, hypothetically, the bank. The bank went bust because a regulated broker, when his capital limits fall below a certain amount, he's closed down by a regulator. So you have to be aware. So the nice thing about a CFD, you don't have to worry about order execution because it's a contract between you and your broker. And that means even in a cascading market, you can get out of that trade quickly and usually at the price you had requested. CFDs are undoubtedly one of the most widely traded financial instruments in the UK and most of Europe today. Growing in popularity as traders around the globe become more familiar with what they are and how they can be utilized as your portfolio. Excuse me. They are traded predominantly off exchange. That means they're through a broker rather than a stock exchange. CFDs provide completely built-in leverage for traders looking to ramp up their earnings. So in other words, CFDs are very easy because your broker offers it to you at, number one, a particular price, but it's all structured. Okay, if you want to buy the Apple stocks, okay, it's already, and it's a CFD, it's already structured. So you don't have to worry about anything. You look in there and see, okay, Apple CFD trading at 150, your leverage is whatever, your deposit per share is $1.50 or $15, and it's right there. There's nothing else to get involved. So it's very, very easy. Okay. And they've taken, the CFDs take all the complexity out of them. So there's many advantages to trading CFD. Number one is leverage. CFDs provide much higher leverage than traditional trading. Standard leverage in the CFD market begins as low as a 2% margin requirement. So that means for every $100,000 you would be trading on an asset, you'd have to put down 2%. Depending on the underlying asset, like shares, each type of market is different. And it's because they are controlled by the regulator who sets the margin requirements, who sets the leverage and constantly monitors it. Okay. Lower leverage requirements simply means lower capital outlay. It does not reduce your risk. It can magnify your profits, but it'll magnify your losses in the same percentage. So while CFDs appear attractive, they also present some potential pitfalls. For one, having to pay the spread on entry and exits eliminate the potential to profit from small moves. So there's a buy and a sell. So you're paying double spread, but it's a couple points. It's a tiny little. So yes, if you make profit, it's going to take a wee bit out of your profit. If you make loss, it's going to magnify your loss a wee bit. But you shouldn't be going into a trade only to look to make 10 points or to make 10 cents. So if you know your spread is there, it's just a cost that you factored in. You're aware of it. So while other types of trades expose the traders to fees, more regulation, commissions, higher capital requirements, the CFD market has its own way of trimming traders' profits by ways of larger spreads. Face it, everybody in the industry has to get paid. Your broker has to make commission. Now, he's putting your trades through an electronics trading system. He's got to pay for all of those things going down the line. Imagine your credit card. When you go into Target or Walmart or B&Q, or you go into one of the big stores and you swipe that credit card through that machine, everybody down the line is paying fees. The store pays a fee, and it gets deducted. So when they put a credit card through for $50, they don't get $50. They may get $49.97. And whoever made those 3 pennies, which is the minimum of the licensing, then an electronics fees going through the local, your home country exchange. If you're using a credit card in a foreign exchange, the bank is making a fee. Then the licensing company, Visa and MasterCard, are making a fee. So this is just the cost of doing business. We know this. So don't worry about commissions and spreads. Like I said, if you're dealing with exotics or unstandardized stuff, it's going to be larger. In most cases, first of all, if you have an extremely large account, or you're dealing with a very large Forex broker and you have a very high account, sometimes, and you trade a lot, because he's looking at you doing huge amounts of trading, because he makes his profit on that spread. So he doesn't care whether you win or lose. He's not against you. He's not for you. But he would like you to see you to make profit, because he'd like you to put more and more and more trades through. So if you're a large trader, he might either rebate or cut his spread for you, but not if you're trading 100,000 or 100,000 euro account and making a couple trades during the day. It's not enough. He won't even deal with you individually. So now be aware that the CFD industry is not highly regulated, but it is regulated. And the credibility for the broker is based on reputation, lifespan, and financial position. There are many fantastic CFD brokers out there, like CMS Trader, who is a regulated provider. But it's important, as with all trading systems, to investigate whom to trade with and which broker best fulfills your trading needs. Now, getting the grips on nuances and the pros and cons of different trading instruments is essential to build a solid portfolio. And while futures and CFDs do bear a number of notable similarities, it's important to remember that they are fundamentally different products with fundamentally different characteristics, which may lend themselves more closely to specific trading scenarios. Okay. Some of the disadvantages versus CFDs is less liquidity than a CFD broker if you're trading futures. Expiration dates, barrier to entry. So these are just some things to consider. But most of us, the CFD is the most popular tool or investment style for most of retail traders. Okay, it is the perfect item for us to use to trade. We don't want to own gold. We don't want to sell silver. We don't want to have oil being delivered to our backyard. We don't want the shares of Apple being sent to our broker and then we have to sign them and sell. No, we're simply looking to trade in the marketplace. This is not investing. This is trading. Trading is to make short-term quick profits. Investing is to buy and hold something for growth. Okay? There's a big difference between profits and growth. Okay? So CFDs are the perfect investing tool or perfect trading tool. They're not designed to be held on. Now you can keep your trade open for as long as you want, but they're not designed, it's not like buying gold and putting it away in 1982 to sell in 2001 and you've made a steady profit on it. It's not to buy stocks that steadily go up in growth value over the years and build a nice nest egg. And this is to do something today to return more capital tomorrow to keep building your cash or your capital account. But you can hold them overnight and wait and hold the CFDs as long as you really basically want, waiting for the markets to swing back in your favor, which is a very important factor. Now, whether you're trading in Forex or you're trading in CFDs, one has to understand leverage. Okay, I cannot explain to you in one few minutes of this class the ins and outs of leverage. We have whole classes on leverage. But basically, leverage is offered you by brokers and allows you to open a position larger than what your actual capital requires or allows. So again, to explain it to you again as simply as I can, if you have $1,500, or say let's round that to $1,000 in your account. Okay. Now, you can, if there was no leverage, you could buy or trade something worth $1,000. That was it. If it was 8 shares of Apple, or you could buy it, if you had $1,000 US, you could buy 1,290 euros, because it's 129 euros today. Okay, or you could buy about 1 ounce of gold today, or you could buy 1/3 of a Bitcoin. That's all you could do. Now, leverage is a tool offered you by your broker. What he's saying is, more or less, we will give you so much leverage, and the leverage is standardized, which means you can ramp up your trading, because they base this on a whole bunch of calculations based on how, say gold is trading at about $1,250 today. Now, we know gold's not going to fall to zero value today. Or Apple's trading, say, at $150. We know Apple's not going to fall down to zero. We know Apple's not going to go from $150 down to even $100. So we know the average, or we don't, but the brokers and the regulators know the average move of an asset. And what this deposit is, or what this margin is that's required, is usually based on these calculations. What that asset might move in a day on a normal day. That's all it is, and it's just simply a deposit. So hypothetically, your broker is loaning you the amount of money that you want to trade. So if you want to buy those 1,000 shares of Apple today, those 1,000 shares at $150 a piece is what? $150,000? No. 100 shares of Apple at $150 a piece is $150,000. But you only have $1,500. So somebody's got to loan you or finance for you the difference. Okay. So your broker says, I want, the opposite of leverage is margin. Margin's your deposit. He says, I need a 2% deposit. Okay. So he's giving you a 2% deposit. That's your margin. But you're actually buying $150,000 worth of an asset. So he's financing. The leverage is what you were allowed to ramp up. How many times your investment, and is standard. So at CMS Traders, we offer up to 200 to 1 leverage based on various CFDs. So for instance, if you wish to trade oil, buying 20 barrels of oil at $44 a barrel, then your position size would be $880, right? 20 barrels of oil at $44 a barrel. 20 times 44, you're buying $880 worth of oil. Well, if oil goes up or down $1 a barrel today, you have 20 barrels. What's the profit you could have made? 20 bucks. Now, however, due to the 100 to 1 leverage offered by CMS on crude oil now, you would only need to put down 1% of your position size in order to hold the position. So you'd only have to put down $8.80 for every 20 barrels or every $880 worth of value. So if you only had $880 in your account, you could actually secure, for each $880, you're securing 20 barrels of oil. You have $880 in your account. So you could then secure what? 100 times this, or the $8.80, or 100 times 20 barrels, which is 2,000 barrels. So if oil went up $1 a day today, you would have made $2,000 on your $880 investment. Leverage trading can magnify a trader's profits. However, at the same time, you have to take into account it can also magnify your losses as well. CFDs are a leverage product. This means that you gain a much bigger market exposure. So again, I'll explain it. Let's say you want to purchase 100,000 shares of Barclays and it's selling at 280 pence, which means that your total investment would be 28,000 pounds. Plain and simple. £2.80 a share, 10,000 shares. You need to have 28,000 pounds to buy those shares. But you don't got 28,000 pounds. So at CMS on shares, basic share trading, not CFDs, we would give you a 10 to 1 leverage. So that means your initial deposit would have to be 2,800 pounds, not 28,000 pounds. So if Barclays shares rise 10% to £3 pounds 8, the value of your position is now 30,000 pounds 800. Your original purchase was, excuse me, let me get my arrow to go back here, was 28,000 pounds. So what did you make? You made 2,800 pounds. Or you made 100% of your investment because you only put up 2,800 pounds and you made 2,800 pounds profit. That's a nice return. The important thing to remember about leverage is that while it can magnify your profits, your losses are also magnified. So, there are many ways that you can understand leverage and margin, but it is the crux to CFD trading, but it's simply added in to simply and calculate it. So when you're trading CFDs, it's automatically calculating your leverage. It's quoted with what your margin would be, how much, because it's not credit. Now don't misunderstand. You don't have to fill out a credit form, and it's not credit rating based on you. If the broker offers 200 to 1 leverage, it's offered to every client. So now that we covered the basics, you should be ready to trade CFDs. But remember, keep in mind spreads. There's the difference between the buy and the sell price, or the ask and the buy price. It's just like when you go into the currency changer on vacation and you want to buy or whatever currency it sells. Now, Forex is similar to CFDs. It's a leveraged product. It does about the same thing, except the Forex market has $7 trillion per day turnover. It is one of the largest exchanges around the world. Now, the Forex market is open 24 hours a day, 5 days a week. Now, most CFDs can be traded 24 hours a day with your broker because it's a broker-generated product. Currencies can be traded 24 hours a day, 5 days a week. But the biggest thing that people are surprised about, there is no currency exchange. There is no big exchange selling and buying currencies. There's nothing like the New York Stock Exchange. Okay, there's nothing like the Tokyo Stock Exchange. It is a hookup of computers around the globe constantly monitoring these trades. But there is no exchange. It should be noticed there is no central marketplace for Forex. Trading is instead considered to be conducted over the counter. It's not like stocks where there's a central marketplace where all the orders are processed. Forex is a product quoted by all major banks, and not all banks have the exact same price. Now, the broker platform takes all these feeds in from the different banks, and the quotes that we see at our brokers is an approximate average of them. It's the broker who's effectively transacting the trade and taking the other side. They are the market maker for you. Okay. That isn't true with most online brokers. Most online brokers are not. They're platform providers. And they are using liquidity providers, which are either big banks or big corporations that provide this liquidity. And these are regulated also. Market makers are regulated, or more highly regulated by the regulators. So, a foreign exchange market is a globally decentralized marketplace that determines the relative value of different currencies. Unlike other markets, there is no centralized depository exchange. Instead, these transactions are conducted by several market participants in different locations. It is rare that any two currencies will be identical to one another in value. And it's also rare that any two currencies will remain the same relative value for more than a very, very, very short period of time. Currency values move continuously because they move in very small amounts called a pip, which is 4 decimal points to the right. Now, one of the biggest advantages of trading the Forex market is volatility, because Forex or currencies continually change in value, that you can easily make profit. Because like the stock market doesn't really move in value. If you're going to trade Apple shares, whether you're trading in CFD or you're trading on, buying Apple shares don't change that much in value. They go up wee little bits at a time. Where the Forex market can be highly volatile, even though it very rarely moves in more than 1% per day. Okay, it's that when you're trading in small increments, and those little pips, because you're using leverage and margin, can turn into huge amounts of money, because you're trading $100,000 worth of the euro US dollar, and it moves 20 pips. That's now it's 3 decimals to the right. 20 pips at $100,000, you made $2,000. But remember, you're always comparing one currency to another. Okay, this may seem confusing at first, but it's pretty straightforward. For example, when we talk about the euro-US dollar at 140.22, shows that how much 1 euro is worth in 1 US dollar. The quoted currency on the left, the other currency on the right. So how much is 1 euro worth against the dollar? Today we're getting about 129, so that means for every 1 US dollar you would get 1.29 euros. Currencies are sold in lots from 1,000 currency units on up. Now a pip is very important. A pip is a unit you count for profit and loss. Most currency pairs, except for the Japanese yen, are quoted to 4 decimal points. This fourth spot after the decimal point is equal to 1/100th of a cent. But the Forex market is a little bit more complex. But again, because online trading has broken it down and made it easy for you, you simply pick the pair you want to trade. You see the buy cost and the sell price, and you can sell short, you can buy long, you can sell now to buy back later, buy now, sell high, and it tells you right on the platform what your leverage is, what your cost will be per pip, what your profit or loss will be per point movement. Okay, so today's trading, web-based trading platforms are relatively easy. You can move up to more advanced using an MT4 platform, and that is for more experienced and novice and more professional traders. But a web-based platform is a great way to start. CMS offers both mobile trading, MT4 platforms, and web-based trading. The prices are the same. Okay, it's just the complexity and the types of trades that can be generated. You know, the more advanced the platform, if you're using MT4, you can have more advanced order entries. But these get more and more confusing, and you have to become more knowledgeable of these. But eventually, you should be using the more advanced stuff and understanding order, because it's really more about understanding order execution, money management, and risk management than it is whether an asset's going to go up or down. Okay. And you need to spend time learning this, but it's not complicated. You can start trading CFDs by using some hunches, by using some common sense, reading the headlines, and understanding. We know gold's a safe haven, so if something kicks off crazy with North Korea, we know gold's going to go up in price. Okay, you can take a CFD to go up. So this is hopefully just a very beginning of some general understanding, a place for you to start. And then you can take it from there. CMS Trader offers extensive videos and one-on-one training because they'll make sure that you understand every drop of this. So thank you very much for joining us tonight. Again, like I said, this class has been recorded. You can get a copy of this recording, not a copy, but you can see the recording by using the same link you used to come to tonight's class in about 24 hours from now. Thank you very much, and thank you for being part of CMS Trader and being part of the Investing.com family. Good night now.